I haven't been able to figure out whether they're going to do like a new schedule or a new form, or just put it maybe on the actual 1040 as a line item. But the big picture on that would be that you don't need to itemize deductions, right, to claim it as a deduction. The tips to W-2 employees will qualify, and also 1099 contractors. So that was something that was on a lot of people's minds is, will people that do DoorDash or Instacart, those 1099 type of gig economy types of work. And it looks like those will be approved. There are some income limits, and they're making a list. They're supposed to be making a list of qualified professions that regularly receive tips in 2024 or before. So they're trying to kind of prevent people from gaming the system, so to speak, and reclassifying their tips as, or their regular income as tips, right? Sole proprietors can only deduct tips up to the amount of their net income. We haven't seen the actual tax form changes. Like I said, I'm hoping to get that to you guys in the version 2 or version 3, or maybe next month's update. We'll have more info on that. It is up to $25,000 for married filing joint, or $12,500 for non-married filing joint clients. So potentially a nice little tax break for service workers. No tax on overtime. This one was a little bit interesting. It's similar in terms of the limit, so up to $25,000 for married filing jointly. Again, we don't have all the details. We don't necessarily know how the forms are going to look, but this is going to apply for tax year 2025, which also is no tax on tips. So it's rather immediate. A lot of these changes are going to be happening, that in the returns that we're preparing for this upcoming tax season. The overtime, there's an income limit, right? I know with you being a tax professional, one of the first things you probably thought was, what's the definition of overtime wages, right? How can we kind of have as much as possible categorized into this non-taxable area, or avoid tax on as much wages as we can for our clients? So I put in here the actual definition that they're using for overtime. From what I could tell, this definition is going to exclude like an S corp shareholder employee, like somebody that owns an S corporation, paying themselves overtime. But that's something that might be good for discussion as we go into the discussion phase, or the Q&A, getting creative phase of this of today's session. Employers, so this looks like it's going to be something that needs to be shown on the W-2, like which part of the wages qualifies as overtime wages. Then as tax professionals, tax preparers, we would then enter that. Not sure yet, but I guess it's something we're thinking about. Like, what do we do when that's inaccurate or it's not present? Because I'm sure that the payroll processing, they have to handle this, and maybe some payroll companies will handle it better than others. So, but it's supposed to be separately stated on the W-2. And I had a typo in the course about this that somebody let me know, which I corrected now, but only the overage amount. So like, it's not the actual full hour worked of overtime, but it's only the amount that you're getting paid more because it's overtime. That's going to be the qualified overtime wages, right? And I have an example here that if you make $20 an hour normally, and then overtime you make double time, $40 an hour, you're gonna have the deduction available for your overtime wages of that $20 an hour for the 10 hours. This one is interesting for people that buy new cars in 2025. You're going to be able to, if the car has final assembly done in the USA, to deduct the car loan interest, which we haven't been able to deduct car loan interest ever since I've been doing taxes, since like 2002. But I remember that people would tell me that, hey, we used to be able to do this, and they looked on that very fondly. So this will be an interesting new deduction that people may be somewhat excited about. It's also not necessary to itemize this. It'll be able to be deducted even if you don't itemize. And it looks like there probably will be some kind of a 1098 that's going to show the interest amount for the loan. And in terms of verifying that the final assembly was done for the car, this is one of those things that we're kind of waiting to see how we'll be able to kind of check all those boxes and make sure that it qualifies. But that's stuff that I think will come clear as we approach tax season. This is sort of the early draft, just getting familiar with what the actual changes are. And it's up to $10,000 of interest that would be able to write off. This one was a big one for a lot of your clients, a lot of our clients, where this somewhat notorious cap, it depends like what state you live in, how notorious this is. But certainly this is something that in higher tax states and with higher real estate taxes for certain clients, especially, has been limiting a lot of the deduction that we used to be able to claim, right? Back, in 2017 and prior. Only $10,000 of state and local taxes, including real estate taxes. And that's now been raised to $40,000, which is, it's quadrupling it, right? So it's a pretty big tax break, especially for clients in the higher income tax rate states or higher property tax states. One thing I was going to kind of throw out there with the old thinking face emoji is the interaction between the pass-through entity tax strategy. So we've done a lot of work on that with members and letting you guys know about that. A lot of your clients, if you have, especially higher income business clients, but like S corporation clients, higher income Schedule Cs, not Schedule Cs, but entities. So mainly S corporations, the pass-through entities. We've been using that to kind of work around the SALT cap limitation. So now that limitation is higher, what is that interaction with the pass-through entity tax strategy? Do you still want to continue doing the PTE strategy? Do you want to make some kind of adjustment? Do we need to coordinate those two? So that might be something we could throw out for discussion. I got another chance to use the Squid Game meme here. The 1099K thing has gone, as you guys know, through many iterations where they keep trying to announce this and they're doing this and then they're changing it. And then so they basically just took it back to the old rules where it's over 20,000 payments processed and over 200 transactions to where the payment processor, payment settlement entity is required to send a 1099K. And if both of those thresholds are not reached, then the payment settlement entity, like the credit card processing company, for example, doesn't need to send a 1099K. So we'll likely see, a great decrease, I guess you could say, of 1099Ks because it's going back to the previous rules. This might be something too to coordinate in our discussion for this session is like, how does this impact if you do 1099s for your clients? So for example, if you do 1099 NEC preparation for your clients, we've had in past years to exclude the 1099K amount before we prepare the 1099 NEC. So does this rule change of, fewer 1099Ks? Does that change your process on that? Does that change your service delivery? That might be something that people have questions or comments about. The QBI deduction, they had talked about taking it up to 23%, which, I got slightly excited about at least. They actually kept it at the same percentage, so 20%, but they have a slower phase in now for, the SSTB, the specified service, trade or business types of businesses, accountants, attorneys, tax preparers, tax professionals, that higher income clients now will have a slower phase out of their QBI deduction. And they also put in a minimum QBI deduction of $400. So there's a couple kind of slight improvements, you could say, to this deduction, which is obviously very popular with self-employed and business clients. Speaking of business clients, not sure how many of you have dealt with this particular issue. I only had a few clients that had this, but those clients, it was hard to accept the way that they were requiring us to do this, where if you had research and development expenses as a business client, they were requiring to amortize those expenses and take the deduction like little by little instead of writing off all those expenses. Like, for example, if you have contractors that you're paying, that the payments to them qualify as research and development expenses, you had to like push off that deduction and amortize it over a number of years.
Thanks so much for joining us. We really hope this session was helpful for you. If you enjoyed this and want more support on your tax professional journey, consider joining one of our Pronto Tax School memberships. As a member, you get to join weekly live mentor sessions just like this, access tons of advanced tax courses, be part of our private member groups, which is great for networking, grab special discounts for our live events, and even get tax business growth coaching. There's a lot packed in. Check out the links in the description to see the details for our Dream Team and Forever Edition memberships. We'd love to have you join our community.